Hi, Sushanto. Good afternoon.
Hi.
Thank you for joining us today.
Yeah.
Thank you
Hi,
for.
Abhishek. Yeah.
Hi, hi. How are you, sir?
Thank you very much. Thanks for hosting me here. Very grateful for this opportunity.
Thank you so much, sir. So just wanted to go through few of questions I would like to know from you as an investor. So why should investor look at a startup investing as part of their portfolio?
Yeah. So I think first thing is, as you know, we were just talking about this 2 minutes ago that the world is changing and that change is very rapid in with technology. So what was the way 10 years ago you had 20 years ago you had retail chains all over and they were growing very fast, but then you had e-commerce and now you have quick commerce. The stock markets and other things don't really follow that change. It takes some time for the stock markets to change with the growth in new industries, because they have to go public and list and so on. So if you want to be part of the growth industries such as say quick commerce or AI and so on, you have to invest much before the other public gets into investing in them. So that is one reason why you should they also offer, therefore, because there's high growth, they offer you high returns, right?
Right.
And you are able, they are able to outperform, the normal indices and so on and so forth. So, like a typical private equity VC fund gives you about 27% IRR vis-a-vis public markets, which give you, 10, 12%, 15% IRR. The other is that you're also not just about the financial part, but even it diversifies your risk, because the startup velocity and direction is different from the stock market. So it adds diversification of your portfolio. And last and not the least, of course, is that you are encouraging startups. They generate employment. You learn new things, you meet new people. As I was telling you, how important it is for me to be in touch with the world is one way of being in touch with the world, not financial but otherwise.
Nice, nice. So I would like to know more about how does a startup investing compare to traditional assets like real estate, stocks, and mutual funds?
Right. So as I said, startup investments are high risk. They give you high returns, and they're also illiquid. They don't necessarily follow the same trajectory as stock markets. Today, maybe in India, for example, as we speak in February 2025, the markets are down about 10% over their peak in September, October of last year.
Right.
But that has not significantly affected the velocity of transactions or investments in the startup world. So these two worlds are not related to. So therefore, it does not behave like the stock markets or real estate markets and so on and so forth. The other is that you can have spectacular returns. You can get 50 times, 100 times your money in a matter of 5-6 years, which is almost impossible to do in the stock market or banked fixed deposits or even real estate. And I think that over a period of time, this should be a part of everybody's portfolio.
Okay, so the risk is high, but the chances of return is very high.
Reward are huge. And yes, the truth is that out of 10 investments, maybe 5 or 6 will go down completely.
Correct.
But the balance 3 or 4 will give you such returns that they will, if you're giving 100x in 2 companies, then you already have 200 times your initial capital. It doesn't matter if 5 or 6 companies go down from a overall portfolio perspective.
Yeah, we can balance it from those who are.
Right. It needs to be diversified. So I can't expect that I will invest in one startup and I will get 100%. I need to invest in 10, 12 startups, and then maybe one, two, or three, depending on how which portfolio you join, will give you that sort of return.
Like similarly, we choose equity market where we have to invest
You have to
diversify.
diversify, yes.
So can you please let me know what kind of risk reward profile should an investor expect when investing in startups?
Yeah. So as I said, the I shared the risk. One is that most startups fail, and even when you invest in startups, maybe out of 10, 4 or 5 companies are likely to fail, and only 2 or 3 of them will give you the returns. As I said, that probably one should expect 25 to 30% sort of IRR returns on your capital invested, provided it is over a diversified portfolio. And the investor should also understand that my investments are not liquid. Like if I am buying stocks in the stock market on an FD in a bank, I can go the next day and liquidate my FD, or I can sell the stock. Here, liquidity is a blue moon event. It doesn't happen every day. When the company is going IPO, or when there's a new investor, or it is getting acquired, these happen once in 2, 3 years, and that is the only liquidity window that you get. So accordingly, you have to plan your cash flows, saying that if I'm investing in a startup, then I must be comfortable not looking for an exit for 5, 6 years.
Correct. Correct. Otherwise, we will not get that much return which we are expecting because things take time to correct. In a stock market, we see that all the companies are well matured. They are in business from some couple of years. But startups, they are still struggling and to find out the way to stand in the market.
Yeah. So it's a trade-off. If you see some of the startups which have recently got public, like whether it's Zomato or Swiggy, they are showing 30, 40% growth per annum. They are in consumer goods, right? FMCG and consumer durables. But the actual brands like Unilever or Procter and Gamble, they are only showing 4, 5% growth. So, as you rightly said, mature companies are in the stock market. The growth companies are outside the stock market, and therefore, as smart investors should have an exposure to the companies which are yet to go public.
Correct. Opportunity, like how they are working and what growth we see before investing. Correct. So, what exclusive advantages do you offer to investors who might not get on their own?
Yeah. So, in the past, and largely in India, people have been investing, doing startup investments, but largely doing in the friends and family. That means some relative of yours is setting up a startup, and the rich uncle or aunt gives 5 lakhs of rupees to start. So it is not in a structured way. Just like people were investing in stocks based on what they hear on the phone. Somebody says buy this stock, and they would buy it. People were not doing it systematically. So I think when they invest with somebody like Lead Angels, they will get a structured way of investing in startups which have gone through some certain level of diligence, where we search for about 100 companies and select one company to invest in. We also make sure that there is another big investor who's investing in the company. We track that company on a quarterly basis. We share, guide the company along with the VCs of how they should go forward. So it substantially mitigates some of the risks which a individual investor may find it difficult to do in her own or his own, right?
Yeah.
Because then he or she is doing other things as well. That is not the only activity that an investor. If you need to invest in startups, it has to be a full-time job.
Yeah.
So just like you give your money to a mutual fund to manage and don't have to worry about what's happening to the stock markets, the same way if you give allocate money to an angel fund like ours, we will look after that money, and you don't have to worry about choosing the startup, tracking it, finding out, giving help. Of course, you can help. We want investors to help, but it is not necessary. Whereas if you were to do it on your own, it would become necessary.
And you're dedicatedly doing that job, meeting with
This is our team in uh, Bangalore, Bombay, and so on. Only do this 24/7.
Right. Completely you are in this field. Correct. So how do lead angels curate high quality startup deals to ensure better investment outcomes?
So we have created a set of criteria. When companies fall within that criteria, only then the company goes to the next. It's like a process of recruiting a person, right? It goes through it has to match certain things. It should be making revenues. It should be in a high growth area. It should have. So there are various criteria like that. Then we meet the company. The team selects the company. Then it goes to our internal IC. Then it goes to an external IC. And one very important criteria, that it must be one revenue making company. That is our current thesis. And two, that there must be another venture capital fund, which is a largest fund, which is also investing in that as we are investing. So it gives us the validation to think that one, that institutional investors also find that idea interesting, and B, that should the company require more capital in the future, there is a larger VC available to do that.
Nice. So Susanto, how can a startup investment complement on investor existing wealth strategy?
So I think, as I said, one is that it needs to it adds additional diversification to your portfolio. So if you have real estate and stocks, this adds one additional layer of diversification to your portfolio.
Existing.
Two, it adds a high return part to your portfolio. Now, in the last 1 year, the stock markets have not grown more than 7-8% from where it was. And from September till now, it has gone down by 10%. So not stock markets do not always go up all the time, right? They sometimes go down. So this adds that diversification and potentially can give you much higher returns
Sure.
than the stock market. So they can give you, as I said, 25 to 30% return on your capital. Whereas stock markets will give you, 15 odd percent return to your capital. So this gives you a higher. Thing. Having said that, we don't expect, we do not advise investors to put all their eggs in one basket and all their eggs in the startup basket. So we say that 5 to 10% of your equity portfolio you may want to invest in early stage startups and even startups which are about to go public. Like for example, Oyo is going to go public in some time, so we may have availability of Oyo shares for investors to invest, or with NSC, or there are other companies, Razorpay. All these companies are going public very soon. And so even within your private equity portfolio, you can have some very young startups and some very mature startups like Oyo and Swiggy and Zomato. And it's very interesting to note one thing, that unlike other companies which are going public, these startups like Razorpay or Oyo, they have had institutional investors, private equity investors for maybe 10 years before they're going public. So these companies have very high standards of corporate governance and financial discipline, which is sometimes difficult to find in the Indian stock markets. Because effectively, who's controlling Oyo? The institutional investors are controlling Oyo because the founder may have only 5 or 7%. So the overall is controlled by the VCs and PEs who own 70-80% of the company.
Correct.
Which is not the case for many of the companies which are going public. You may have heard the sort of companies which are going public on the SME board, right? The for small and medium enterprises. So corporate governance is also an issue which is actually an advantage if you invest in to the investor if you invest in early stage pre-IPO companies.
Nice. So what is the ideal allocation of one's portfolio to early stage startups?
Yeah. So I would say 5 to 10% of the portfolio, and probably do it in a diversified manner. So we would suggest that you should have at least 10 to 20 startups in your portfolio, because as I said, there is
So
50% to 60% chances that those companies, even after all the curation, will not do so well. You will not get returns from them. The investor has to accept that. When you invest in the stock market, yes, you know that the one stock may go. If you invest in Nifty 50 companies, okay, one company may not do so well. Adani may go through a bad patch, and so, or Unilever may not grow for some time. But you know that Unilever is not going to close down tomorrow or in the next foreseeable future. Whereas when you invest in startups, there's that it's a difference is that some of them will close down, or some of them will give you negligible returns. That is something that it's the investor has to understand and accept that before, otherwise he or she will be disappointed, saying, okay, I invested and it's gone. But knowing fully well that it balances out in the overall portfolio. And that is why diversification is important.
Is more important. So how does lead angels mitigate risk in early stage investing for its investors?
So that I think so. What we do, as I said, is the curation. Is that we look at about 100 startups before we invest in one. We make sure that it meets certain criteria. We make sure that it is revenue positive, and there is an investor who is a large institutional investor who has also gone validated that investment in the company. And post investment, this all happens before we invest, but after we invest, we make sure that the company is reporting its performance to us. If it requires any help, or if it is getting into some distress, sorry, then we can get around to helping the company, which again, for example, does not happen in the public companies. The company, you can't pick up the phone and tell Mr. Adani, I know you're having trouble with Hindenburg and I'll come and help you. You cannot do that. But sorry, you can go and help them.
So, thank you for sharing your thought on investments. So, I would like to know what is the typical exit timeline and what kind of return have lead angel investors seen?
So, as we think that when you invest in startups, you should not expect returns before 3 years. 3 years is the minimum time period before you can expect it. The average would be closer to 5 to 7 years. So that's the exit time period. In terms of returns, you are looking at about 20, 25, 30%, depending on what is your timing and so on and so forth. So some of the investments that Lead Angels has made, companies like Shop Kirana, we have got 21 times our investment. So if you had made 20 investments and 19 of them went down,
Right.
and just one Shop Kirana would have recouped the losses for all the 19 that you have made. Similarly, we invested in Godesi, where we got about 15, 16 times our return. We had invested in a company called Super Daily. Within 18 months, Swiggy acquired that company and investors got 8x return in 15 months' time. That doesn't happen. But so, and there are one or two investors within our group who would have made 10 investments and then which include these three companies. So you can see that they would have made, at least 3x of their original investment at the very least. Yeah. So that is the sort of return that we should expect. But yeah, you have to be patient. It has to be very patient capital. You, like in the stock market, you can look at the newspaper every day and see what is your stock price and what is your net worth. Here, that is not possible.
Wait and watch and see results.
Yeah,
in a couple of years. Okay. So I would like to know more about what sector and trends should we be watching in India's startup ecosystem.
Yeah, so I think AI is all over the place. Prime Minister has recently gone to France in February 25 to talk about AI. So AI is really one of the and I think that trend will continue. It is not done. So a lot of times there's no, AI is all done. Chat GPT is here, it's all done. I think AI has to penetrate deep into the business and our day-to-day life, which is also the next thing I would say is healthcare. I think a lot of changes will be coming in the healthcare sector, whether it is pharmaceuticals or it is medical devices, which will further refine the medicines and the treatment that we are getting. So a lot of changes are likely to happen in the healthcare space. In a country like India is just that making healthcare available and affordable to all, but also from a research perspective, how can AI and electronics be used in improving healthcare outcomes? Fintech is another area where I think a lot of interesting things will happen going forward. In the other area where we think that is the climate change, the whole thing about renewable energy, things which the circular economy, all climate related things is another area, because more and more people are being aware of how we are, the global warming and pollution and all these things. And this will lead to governments and society at large being very, very circumspect about using products which cause a large carbon footprint or pollute the environment. So I think climate tech is a very, very important. So these 3-4 areas would be interesting.
So how will lead angels continue to evolve to cater to the needs of sophisticated investors?
So I think, as I is you have to keep on changing to be relevant to investors. So I think one is that we keep on learning, from the incubator startups, trying to figure out what are the new trends that are happening. Two, that we look at seeing collaborating with others. So unlike a PNG and a Unilever, which are competing all the time, here VCs and funds all collaborate together, and we definitely believe that collaboration is the key for success in startup investing. I think also we keep on training our team, because finally the quality of investments depends on the quality of the team, and we keep on keeping our team and us abreast of the changes that are taking place, so that we are ahead of the curve, so as to speak, in terms of business and technology trends, so that we can find the most disruptive startups for our investors.
Nice.
Because that is where you can make the maximum amount of return from an investor perspective.
Okay, thank you so much, Sushantoji, for your
Thanks,
time.
Abhishek.